It might go a little bit fast, and I just want you guys, if there's any place where you guys are lost, please stop me. Raise your hands. Let's make this as interactive as possible. The other thing that I will say is that kind of like you guys, I'm also learning too. So if there's anything that you guys have questions about, or if there's anything that I say up here that maybe you might know the answer to, like Amir was able to contribute a lot last time because he's actually a real estate lawyer and he knows a lot of these laws. But I mean, it's really collective because we're here to learn from each other. So I want to make sure that we all kind of participate and we bring whatever we have to the table, okay? Participate. Don't be shy, please. I'm serious, because there was, after the first class, I was talking to somebody and they were like, yeah, you said some acronyms and we weren't really sure what that meant. I was like, for me, I look at this stuff day in and day out. So I might say something and not really explain it, but it makes sense in my own head because I talk about it all the time. But for you, you might not, you'll be like, huh, explain that. So please stop me, okay? And I'm kind of glad the class size is a little bit small today. We might have some more people trickle in because what it allows us to do is to really make sure that you guys are understanding some of the concepts that we talked about, okay? All right, part 3, cultivating a lifestyle of investing. So like I said, this is really one of my favorite topics. We're really gonna deep dive into all things market related. So we're gonna talk about everything from stocks, bonds, ETFs, index funds, REITs, et cetera, right? The only things which we're not gonna talk about are commodities. And it's mostly because I am not a commodity investor. Some people invest in gold, in wheat, in oil, those types of commodities. And if you remember from class 1, commodity, the definition of a commodity is anything that comes out of the earth. So if it comes out of the earth, it is classified as a commodity. And there are people who do make a lifestyle of investing in different types of commodities, but I am not one of them, which is why I'm only going to tell you what it is, and then we're going to skip right through, okay? Yeah.
So the companies who do mostly commodities, classify under that, like Chevron, oil and gas, energy companies, or they?
So it depends. So when you look at commodities like that, it's basically based on contracts. When people buy into commodities, or you might have a mutual fund that sells commodities, so you can invest in commodities via mutual funds, and we'll talk about it, and that's always going to be my default recommendation. But what you do is that you buy a contract. So let's say you have let's say you have a farmer has a bunch of wheat, right, that they want to sell. And what they can do is that before the harvest, they sell the contract to be able to provide like a certain like that, let's say half of the field or two barrels. I don't know what the wheat terms are. We say I'm going to give you two barrels, and you sell it to somebody. So you're selling the harvest ahead of time. So that tends to be what happens with commodities. With oil, you're selling the different barrels to maybe, I don't know, whoever is going to use the oil. So that is how the commodity trading tends to work. But like I said, I'm not an expert in commodities, so I don't want to take you guys down the wrong path. So, all right, so let's go to the next one. I always include this disclaimer. I know a lot, but I am not licensed in any way. I'm not a financial advisor, etc. So whatever I say here are what I have learned over the years. So don't come back and sue me because you ain't getting nothing. All right, so. And the other thing I know is what I want to do is to empower you guys to take your own steps. So in that, I'm saying that to kind of also say that I've had, a couple of people who are like, oh, we have this money to invest. Can you invest it for us? And the answer is no. Well, one, because it's illegal, because I'm actually not a licensed financial advisor, so I cannot invest on behalf of another entity. But what I can do is I can sit down with you guys. Like I said, I'm going to be here after this session. So if you guys have questions, I am happy to sit down and you can run through scenarios. We can run through it together, or you can say, what do you think about this stock? Or what do you think about this mutual fund? And I'm happy to provide just Loretta's opinion, okay? But we're just going to call it that. It's Loretta's opinion, okay? All right, so let's get started. Investing is very, very interesting, and I think that this, to me, is the biggest part about investing that you need to know, especially when it comes to the stock market. And it is the fact that the greater the risk that you take on any asset, the greater the reward. But the inverse also works, meaning that the greater the risk that you take on any asset, the more you can lose, okay? So let's take a look at this, right? For recent purposes, everybody knows Tesla, right? The car company. Recently, Tesla stock has been skyrocketing. You were in the first class where I actually talked about Tesla stock. So before Tesla started skyrocketing, my dad is very, very interested in all things space. And he was like, oh, that SpaceX company, we'd love to invest in them. Well, they're not a public company, but SpaceX is actually under the tutelage of Elon Musk. So I was like, okay, I'll buy you guys some Tesla stock. So I bought Tesla stock. And you see there was a lot of volatility when we had his stock. I bought it at $300. It would go up, I think, to like $385, and then it came down to like $275, and then it went back up. So there was just so much volatility in Tesla stock. Then at one point, I think once they had their earnings announcement and they showed that they weren't shipping enough cars, the stock crashed. Actually, no, let me tell you what happened. So when Elon came out and he made that tweet about he's thinking about taking Tesla private at $420 funding secured, right? I was like, Dad, I'm getting y'all out of Tesla stock. So I actually sold I sold at a loss because I was like, there's too much volatility in this stock, right? I'm trying to make money. I'm not trying to find that one stock that's going to make me rich. So I sold their stock, and when that came out, right, their stock shot up all the way to like $385, right? Because he said he's going to take it public at $420, right? And he said funding secured. Turns out his funding wasn't secured. He got investigated by the SEC. He was asked to step down as the chairman of the board or something like that. And their stock plummeted. I think it went all the way down to almost $200. So, and then after that, I think now they're I think it was October. Between October and now, their stock has basically 4x'd. I think it's trading it's right under $1,000. It's like at 900 and something, right? So the growth has been explosive, right? But I gave you that example because Tesla is a risk to me. In the way that I look at Tesla, it's a risky asset. Anything that has the ability to double, triple, quadruple in 2 months has the ability to half in a quarter, in that same amount of time. So exactly. 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 And that's part of the reason why I look at it and it's under 1,000, right? And people will look at me and be like, oh, do you regret not keeping your Tesla stock? I have zero regrets, even though it's under 1,000. And my dad, him and I even had the conversation. He was like, what if you just get one? We're ready to lose all the money. I'm like, no, I'm not investing to lose money to figure out, which one we're going to. Exactly. That's a gambling. Thank you, Uncle. That's a gambling mentality, right? You're investing to actually make money. So you guys got to remember this. In fact, if anybody tells me, oh, we have this investment, right, and it's going up 20% every single month, I will run. That's too much volatility. If I'm not willing to sustain a 20% loss, but I love the gains, then I shouldn't invest in that asset. If you're willing to sustain that 20% loss, yeah, go ahead and invest in it. But if you're not, that's not the asset for you. So as we go through the class, we'll talk a little bit about that concept because I want you guys to always remember that at the back of your mind because it's going to go into play when we break down the asset classes, etc. All right, so let's look at the different asset classes, right? So there are 5 primary asset classes when you look at the market. There's cash. Cash is an asset, right? And cash actually has a place in your investing strategy. And we'll talk a little bit about that towards the end. There's cash, there's stocks, there are bonds, real estate, and then there are also commodities, okay? So the three that we're gonna look into are stocks, bonds, and real estate, okay? Everybody understands cash, and I'll show you how you use cash in your portfolio. But beyond, and we already talked a little bit about commodities and what they are. I'm not gonna spend too much or belabor the point on commodities. So whenever you are investing, right, whether you're investing through a 401k, you're investing, having a personal investment account, you're investing through a brokerage. Okay, a broker is basically just somebody who brings a buyer and a seller together. Okay, and what happens whenever you trade an asset, a stock, right? You have, let's say Amir is going to sell his stock, and Amir is like, I want to sell this stock at 320, and I say I want to buy this stock at 320. If the stock transaction matches, then Amir is selling his stock to me. So a broker is only somebody who brings those two people together, right? Many times when you're investing through brokerage firms, you don't see it, right? But they are managing the interaction between both, right, on the back end. So these are the most popular brokerages that a lot of people know. E-Trade actually just got purchased, or they're going to get purchased. I can't remember who it was. Yes. Yes, thank you. That was Thursday, right? Yeah.
So then, when you sold that Tesla stock, who bought it? Tesla?
No, somebody else. Yes. So whenever you sell it, it's the only time a company buys it back is if they have had a buyback program. Okay? So if a company has a buyback program, then they go into the market and they buy back shares of their stock. But if they're not buying back shares of their stock, it is another independent seller. And when I say independent, it could be anywhere from a hedge fund to, I don't know, another person like you and I who's trying to buy that asset.
So what will make a seller or the company to buy back their...
They have a lot of cash. So a lot of times...
Try to take ownership again.
Yeah, so a lot of times when companies buy back their own stock, they have a lot of cash, and they believe that the stock is trading below the intrinsic value for their asset. So take, for example, Apple, they're always the best example that I can think of. They've bought back, millions and billions of their stock, right? And we'll talk a little bit about what happens so they have a certain market cap. And the way you define a market capitalization is basically the value of a company. And it's calculated by taking the number of outstanding shares. So every single company has a number of outstanding shares. You take that, you multiply it by the price, and you come out with the market cap. That's the value of the company. When a company buys back their stock, they'll buy back a portion of the outstanding shares, and it basically gets absorbed into the company. And what that does is that it reduces the number of outstanding shares, right? But if the market cap is the same, then the stock price goes up. So the stock price basically tends to increase when you have a buyback program. So if you look at when the Trump tax cuts a couple of years ago, right? A lot of corporations got, they got a lot of tax cuts, right? And with all the money they were saving, what people said was that they were going to take the money, increase wages, get more jobs out on the market because they had a lot of money in their bank accounts. I see you shaking your head. You know exactly what happened. But what happened was that they took that money and you started hearing a lot of companies buying back their own stock. When they buy back your own stock, you're increasing that stock price. So guess who's getting rich? The people who exactly. So that is what tends to happen whenever you have a buyback program. Okay.
But then, when you see the company buying back, is that a sign that, whoa, if they're buying it, let me also?
Yes. A lot of people see that as a positive sign. Yes. So because it's
Confidence
in their, yes, in their direction and everything, right?
So how do you know that they're buying it back though?
They'll announce it.
Okay.
Yeah, they'll announce it. So Pros hasn't bought back any shares, and I don't know if you remember when Andres is our CEO at our company. We both work at the same place. So when they talked about the corporate tax cuts, and they were like, "Oh, Pros, you're saving all this money," and Andres was like, "Oh, what are we going to use this money with? Pros is not profitable, so it wasn't like we had a bunch of money just piling up. We do have cash, but it's not. We're not in the positive, so we'll tend not to go buy back our own stock." But everybody from Amazon, no, not Amazon, Apple, Berkshire Hathaway, there were a lot of people who were buying back their own stock. So, okay, so one of the things that I wanted to point back, let me go back a couple of slides. In all of these scenarios, we're going to talk about ownership versus being a lender. When you're an owner, you actually own like a portion of the company, okay? So in a stock, when you have a stock, when you have a mutual fund, when you have an index fund, when you have a REIT, if you have real estate, like let's say physical real estate, you are considered an owner. In a bond scenario, you are a lender, okay? So when you say I have a bond, right, or I'm going to provide you a bond, it means I'm going to lend an entity X amount of cash over a given amount of duration at a given, and they call it a coupon rate, and the coupon rate is the interest rate, okay? Let me go in here. So a bond is basically an IOU, all right? So it's you guys, if you think about it, in the example, everybody, I think almost all of you guys in here, with the exception of Chitara, has mortgages. So in a mortgage example, right, you have a mortgage lender. They give you, let's say they give you $100,000 to purchase your house, and you are purchasing the house at a specific interest rate. They're going to make money on the interest, right, that they're getting. That is exactly what a bond is, if you think about it in that sense, okay? So bonds are also known as fixed income assets. That's because if you calculate the time duration, given your interest rate, you know how much you're going to get back on the bond, all right? So they typically, the bond, interest rates are paid out, I believe I forgot. It's either, I think it's twice a year, but I'm not 100% sure about that. So yeah, it's either twice a year or it's every quarter. I can't remember. But basically, you think about these, and you can think about them as dividend payments that are coming back on your assets. So the coupon rate, when you hear coupon rate, interest. All right, that's what you're getting back for lending somebody. So I can go out and I can make a purchase of a bond. Let's say I put $10,000 into the bond market for X, Y, and Z at a coupon rate of 4 or 5%, and let's say with a maturity time frame of 30 years. That means over the duration of 30 years, they're going to give me 5% on my initial investment. And after 30 years, they're going to give me back my $10,000. Does that make sense? Everybody follow? Mm-hmm. All right, perfect.
Well, is it possible to make a loss when because you say you're lending? Right?
Yes.
You lend the money to a company and they do business with it and it goes south.
Yes.
Is it
Yes.
possible that you, the lender, can also make a loss?
Yes. We'll actually talk about that because you're going into the second part about bonds, which is the credit rating. And so remember, the greater the risk, the greater the reward. So if you see a bond with 8% or 10%, it's most likely they have a junk rating. So yes, they're more likely to default. That's why they have a higher interest rate. Okay. All right, so let's talk about classifications of bonds. There are three major types of bonds which are sold out on the market. There are treasury bonds, there are municipal bonds, and then there are also corporate bonds. Okay, Treasury bonds are backed by the full faith and of the United States government. Okay, these are what the majority of people own in their asset class, in their portfolio, and that's because the United States is most likely never going to default, because all we got to do is keep printing money. They will pay back on their loans. In fact, what's interesting is that, so I don't know if you guys remember, during the trade war, one of the things that China was trying to do to get us to play ball, China holds the majority of US Treasury bonds. And what they started to do was they started to sell those bonds, basically reducing their holding or the amount that they had. So when they were either selling it or calling the bonds, you got to pay. So it's like, okay, we have all this money. So they greatly reduced the amount of money that they were lending to the US government. And not only was China, the majority of other countries, and I'll send you the slides too. The majority of other countries actually hold the United States, and they call them T-bills, T-bonds, et cetera, et cetera. They hold the US bonds, right? And that is because it's better, if you think about it, first of all, their currency might not be as stable. So if you think about third world countries where the currency is fluctuating, right? They might not be as stable, and they also know that they're gonna get interest back on their investment.
Sorry.
Yes?
So now, if you have T bills, that's 1 year. T notes, 1 year to 10 years. T bonds, 10 years to 30 years. So if China was holding T bonds, which is 10 years, to 30 years, but because of the trade war, they started
Selling them.
Do they sell at a loss?
No, it depends on the interest rate which they get the bonds at. So one of the things, part of the reason why, what's his name? Powell, right? Every single time he comes out to make some announcement, people pay it, like sit up and listen. That's because they set the base interest rate and everything else basically fluctuates off of that. I don't know if you guys remembered in a couple of classes back, I said money is cheap. And the reason money is cheap is because his base interest rate is so low, it costs nothing. It costs basically nothing to borrow money. So you look at somebody like Apple, who they put out bonds for $100 million or something like that. They're actually borrowing money. But Apple is sitting on billions of dollars in cash. So the question was, why did they do that? Well, why should I go spend money when money is cheap and I can use that money to do something better that's going to get me more than spending my own money? Does that make sense? So that's the kind of thought process that a lot of people who are working with assets have. The other types of bonds are municipal bonds. These are bonds that are provided by local government securities. And then the last one is corporate bonds. So any corporation, so if you look at when Tesla was trying to raise cash, actually I think that they also just issued bonds a few weeks ago. So they issue bonds out onto the market. Pros can issue a bond. Pros did issue a bond. And I don't know if you remember a couple of months ago where the stock dipped. Yeah, and it was because they had what they call convertible bonds. So what you can do is you can take a bond and you can have in the bond contract that, look, we can either pay you back the bond or we can convert these bonds into stock. Okay, and you have a pre-negotiated, we're going to convert these bonds at 1 to 2 stocks or 1 to 1 or 1 to whatever. If you have a convertible bond and the stock price goes up, right, the value of that bond is increasing. So you can easily convert the bond into stock. And what people will do is that to get their gains, they sell it because they bought the bond really low and now the stock price is really high. So that was why cratered. The stock price cratered.
Most bonds pay interest twice a year.
Twice a year, thank you. So it's 2 times a year.
Have you ever heard about church bonds?
No, but they probably would fall under municipal. Yeah, I would say municipal, not corporate. Yeah, because churches are not treated like a corporation. The only other thing is that you got to remember some of these bonds are they're private versus public. So everything that we're talking about here are public that can be bought on the market. Some of them might be private, and you just have a bond to a given lender. All right, so let's go to what you were talking about with regards to getting your money back. So as with any investment, there is quote unquote risk, right? But you can mitigate your risk. If you think about it, if a person walks into a bank, right, and they want to borrow, let's say $200,000 to go purchase a house, what's the bank gonna do? They're gonna pull your credit report because they want to understand how likely is it gonna be that you're gonna pay us the money back, right? And the lower your credit score, right, the higher your interest payment is gonna be. If you have a great credit score, you're gonna get, the most beneficial interest. The same thing works for bonds. So there are two classifications of bonds. There's what they call investment grade bonds, and there's what they call junk bonds. Okay, investment grade. There are two companies that classify that classify bonds. So the S&P and Moody's. And for every single bond that's out on the market, you can see their classification. Or the other thing is you can look at the interest rate and get a good idea of their classification, okay? If they have an interest rate that's 8%, it's most likely that they're classified or their credit rating is junk bond status. If they have 2%, right, you think about the U.S. government. The U.S. government is classified a grade A. It's a grade A, AAA rating, right? Because you're going to pay it back. They're going to pay it back. But then because they're going to pay it back, the interest rate on that is only like 2% or 1 point something percent, right? So you have to think about that as you're building out your portfolio or your asset profile as you look at the bonds. As you look at bonds. You guys are following me so far? Mm-hmm. All right, good. Fantastic. Okay, so why buy bond assets? Because you think about it and you're like, well, bonds don't have a lot of interest with it. But why? What are some reasons why people buy bonds? Well, because there is automatic passive passive income that you're deriving from the interest payments. So you can think about this as almost kind of like a dividend, and we'll talk a little bit about what dividends are. It's a way to diversify your portfolio and also reduce volatility. Okay. Remember, the greater the risk, the greater the reward, but the greater the risk, you can also lose a lot of money. Bonds, when you start to, especially with investment grade bonds, they're a way to diversify your portfolio while you know you're getting income back. So you're not putting all your money into risky assets. And we'll talk a little bit about what diversification looks like. They are regarded as less risky, and less risky is in quotes, depending on which type of bonds you get. If you go buy a bunch of junk bonds, yeah, you're investing in riskier assets. But if you buy a bunch of investment grade bonds, you know that you're going to be getting money back on that. Volatile going up and down, we don't know what's going to happen, blah, 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 blah. So it's when you think about if I say put your portfolio in a defensive position, it means that invest your assets in instruments that are basically fixed income rather than in stocks. Okay? All right. Let's go. Financial tip number 1 that I got for you guys. Select your bond allocation based on your risk profile and your investment time horizon. I think that one of the biggest things that you guys or people as investors have got to understand is they need to understand themselves. And it sounds very obvious, but it's not sometimes, because when I say understand yourselves, you need to understand how risky of an investor you are. And your risk also needs to match your time horizon. I tell people that my dad is one of the riskiest investors that I know. Because my dad does not realize that he's got to retire in a few years. So my dad is like, he tell you, oh, buy Tesla, buy this. Nah, what if you go lose your money? So you need to make sure that you're investing with two things in mind. How much risk can you tolerate? The best way to answer how much risk you can tolerate is to look at how much are you willing to lose. Don't look at how much you're willing to make, because everybody else, yeah, I would love to double, triple my money. But am I willing to let my money half? If the answer is no, then I'm not that risky of an investor, okay? So you guys got to remember that as you look at investing, it's as much, when you think about risk, think about how much am I willing to lose versus how much am I trying to get, okay? And then your time horizon, so you brought up a good point. Actually, I told you I went up and looked at it. So the 110-year rule or whatever it's called, something like that. So they say you take 110, subtract it by your age, and that should be your bond to stock allocation. I'm probably riskier than that. So like I can tell you guys, and I have my portfolio allocation in later slides, but I have only 10% of my portfolio is in bonds right now. And I know what that means. Whenever you have a riskier allocation, you open yourself to more volatility, meaning that if the market goes up to 25%, I might go up to 25%. If the market goes down by 30%, I probably will go down by 30%. But if I have a more diversified or less risk-averse portfolio, if the market goes up to 25%, I might only go up to 15%. But if the market crashes down to 30%, I might only go down 10%. So that's why I said that. To me, the fundamental rule about investing is the greater the risks, the greater the reward. The greater the risks, the more you can lose. All right. Second thing that I wanted to throw out here is that there is no such thing as a guaranteed investment. I can't tell you the number of people that will come up and they're like, oh, let me invest this money for you or whatnot. And, these people are talking to us and they said that they can guarantee us 8% or 10% returns, over the next 5 years. Unless it's a bond, there is almost no way that is true, okay? So once you hear that, and if there's somebody that you really trust, I would say ask a lot of questions. Once you hear that and it's somebody that you don't trust, I tune off, because it's not, you can't control the market. And because you can't control the market, you cannot guarantee anything. There might be times where it goes up by 20% or 25%. Exactly. But you'll be surprised, because a lot of people, that's how they get a lot of people. Is like, oh, a lot of people want to invest their money, but I want you to guarantee 10% year over year. That's not how it works. Yeah. So unless it's a bond, right? And you invest in a bond, like where you're lending somebody money and they're giving you the interest back at 10%. But remember again what I said, 10%, right, most likely means that they're a junk bond. Exactly. So the likelihood of defaulting is also high. That's why it's at 10%. So you just always gotta look at the trade-offs. All right, so let's talk about real estate investing in the market. So last 2 weeks ago, we talked about real estate investing and investing in physical assets, right? But there is a way to invest in real estate through market instruments, and they're called REITs. So real estate investment trusts is what REIT stands for. And basically, REITs are treated like mutual funds. And we'll talk a little bit about that. What happens is that a bunch of investors pool their money together and invest in income-generating properties, or they invest in mortgages. So those are the two most common types of REITs that are out on the market. So they're either they call them equity REITs, or they call them mortgage REITs. So the way that REITs, I just said that. So the way that equity REITs work is that they actually make their money off of the passive incomes from rent. So they'll go buy like a mall, or they'll go buy like a commercial property, or maybe an apartment complex, and they're getting rents, right, in that. So the rent payment is how they're getting their equities. When it comes to mortgages, it's the interest. So they might get mortgages, but the way that they're getting their money is in the interest payments that are coming in. So if you look at how do REITs work, well, first of all, they're modeled after mutual funds because you have a bunch of investors that pool their money together to invest in specific assets, okay? Then the other thing is that they're also treated like a corporation, all right? That's subject to taxes, etc. But the key thing that you guys got to remember is that with REITs, 75% of the income must be in real estate types of assets. That's why they're called REITs, right? So if you set up a REIT, it means that they're investing in real estate types of assets. The other key thing is that 90% of income that is generated must be given back to the investors in the form of dividend payments. So if you look at, because they're giving back 90%, it means they're only keeping 10%. Some of them give out the whole 100%, right? So because of that, the prices of REITs you won't see it shoot up like you'll see in Apple or whatnot, because they don't have a lot of profitability, etc. But what they're doing is that they're giving back the money that they're making on these properties, on these mortgages, as dividend payments. Okay, you guys following me? Yes. All right, good, fantastic. So equity. So I talked a little bit about the fact that equity REITs makes money based on rent, mortgages based on interest rate, and then they're taxed at ordinary income. The other advantages. Let's look at the advantages and disadvantages of investing in REITs. To me, before I had a.
Can I just ask?
Yes. Yeah.
So under the taxation.
Yes.
Is it taxed in the hand of when the distribution is made, or is it taxed as the entity tax on the REIT?
It's taxed. I believe it's taxed when the taxes go not to the corporation but to you as the yes.
Okay.
So and it's taxed as taxable income. So whenever
That
you
makes sense.
yeah
All right.
yeah.
Okay.
Because and the other reason they don't pay a lot of taxes because they're not making that much money because they're giving all the money back to the investors. Yeah. Oh, you were just leaning. Yeah. All right, so let's talk a little bit about some of the advantages and the disadvantages of REITs. So I was saying before, had a conversation with Tim, I mostly invest in real estate through REITs. I don't have, with the exception of my own property, meaning my own house, which is not really an investment because I'm living in there. But with the exception of that, all the real estate assets that I have, it's true. Yeah, that's true. So all the investments that I have in real estate are in the form of REITs. I like them because they're highly liquid.
Yeah.
So if you think about it, if you have a house and you want to go, let's say you have an investment property, because I know you got a couple of investment properties. If you want to go sell them, right, it's going to take you a period of time before you get it listed, find the buyer, get the mortgage set up, sign it and close. With my REIT, if I want to sell it, I can sell it on Monday and I can have the cash on Wednesday. So they're highly liquid. They also provide diversification from stocks and bonds, and it gives you exposure into a third market, right? That's not based on corporations or it's based on a lending scenario, okay? The other thing is that they provide stable cash flow in terms of dividends, right? So dividends, as you will hear throughout the thing or throughout this today's session, dividends are very, very important, right? Because it's money that you can get back, and when you get a dividend back, you can do one of two things, right? You can take the cash, or you can take it and you can reinvest it back into the asset. So when we looked at the graph in the first class about the art or the science behind compounding, that's what you're basically compounding. You're reinvesting your dividend payments. So it's like you're investing your capital gains, and your money's just growing even higher and faster. And then the total returns for REITs are actually above the S&P 500. So it's a very, very strategic, and it's a good way to get exposure to REITs. Now, the one downside I would say in REITs is that although it's a third market, they're also susceptible to market crashes. Okay? So take, for example, with the coronavirus that's going on right now, right? REITs aren't doing as well. They might not crash as hard and fast as the market will, but they sometimes tend to follow the market dynamics. Yeah. So that's the one thing that I would say would be the downside to REITs. The disadvantages, they don't get a lot of capital appreciation. Again, it's in the when I say capital appreciation, meaning the price. So if I buy a REIT at $40, I'm not going to see that $40 go to $80, and it's because they only keep 10%. Okay. And then the other thing is that it's taxed as income. If it's in a retirement account, you don't care. Because however it's taxed, you're not paying taxes in a retirement account. If you're outside of a retirement account, just know that you're going to be getting some tax paperwork that you got to file with your accountant. And then, like I said, it's subject to market risks. Okay? All makes sense?
Can I ask one more question?
Yes, please.
When you talked about being able to sell it very quickly in terms of liquidity, if you need to generate some cash, you can sell it within 3 days.
Yeah.
Have money in the bank account. So how does it work? Is it tradable?
Yes.
Okay.
Yeah, so it literally, so the REITs have a ticker. So, yeah, so, and I'll actually show you, so in the example, when we go into Fidelity, I'll pull up the REIT that I invest in, it's FRESX. And it's not a REIT, it's a mutual fund, because I would recommend that you guys invest in any instruments based in mutual funds. So the mutual fund is investing in a bunch of REITs. Okay. So that way I diversify and I reduce my risk exposure to just one REIT. Yeah.
How are the returns above the S&P 500, but your capital is not appreciated?
Because of the dividends. So they think about it. When you look at the returns, it's not the return on the growth. It's a return that you're getting in the form of pay. Yeah. That's a good question. Okay, so a lot of people actually invest in REITs. So just throw these numbers up here. So 80 million Americans own REITs through their retirement savings and other investment funds. Say that again?
I said they don't even know it.
Yeah. So I invest in REITs in my 401k and also in my IRA. There are 53 billion stock exchange REITs, and they paid out approximately 53.2 billion in dividends, and that was in 2017. And they have an equity market cap of over $1 trillion. Wow. So there are a lot of REITs. Yeah, there are a lot of REITs out on the market. A lot of good ways. So, but for me, this was before I sat through Tim's session. This was an easy way for me to get into real estate, and one that I understood. Yeah. with some of the other ones, it's like, oh, how do we do this? So since it's a tradable instrument, I was able to do it. It's
keep you awake at night.
No. My AC is out. Were you gonna say something, Rocco?
I will leave it to later on.
Okay.
Which was why I asked the question last week about REIT, because I've read a bunch of articles, people trying to argue pros and cons.
Yeah. Yeah. So for me, I think it goes back to what Tim said about understanding your identity as a real estate investor. For me, I know my identity is not managing properties. So my identity is sitting back and letting money come to me, however that happens. So if it's happening through a REIT, that's how it is.
So then, what I'm hearing you say then is that really, one of the most important important things that you need to do is to know who you are
Yes.
and what you are trying to do
Yes.
and achieve.
Yes.
Because that will say or dictate how you do anything and everything else.
That's correct. And that's why I sometimes sit you down and I'm like, Dad, what are your goals? And he never tells me. You don't know.
One other thing that I think is very important is how well you can manage these assets. Because for some of us, we are like reactive investors, you know. We probably don't have the time to, the same amount of time that you have to monitor. So that will help you to determine, okay, which of the
Assets, yes. Yeah. And that's a very good point, because then what you can do is you can implement a strategy that diversifies you and reduces your risk, and it's easy to manage. I mean, for me right now, I was looking at my parents' account. So I actively manage that one, and I don't have a lot of mutual funds for them. And that was because I intentionally did that strategy because I'm trying to grow their portfolio fast. But I was looking at it and I'm like, all this work and I'm barely beating the S&P. When I say I'm barely beating, I mean like maybe 1%. So it's like, it's not even worth it. Just put it all in the S&P. And that's why I was telling my dad, I'm like, I'm about to sell all of y'all's assets and get you down to 2 mutual funds and call it a day. So it's...
Don't you think, Loretta, that is because of the unusual situation we're in, at the moment? The S&P 500 is roaring, a lot of, so it's very, when you look at it over a period of time, a continuum, you actually see that it levels up, so maybe your strategy is still,
It's still good. Yeah, I mean, it might be, but it takes a lot. Like, I literally am in their account every single day, but I have a day job. So I'm like, you gotta check and see, unless you know what's actually going on with their assets when the market crashes, right? Because remember what I said, cash is part of your strategy. Because when the market crashes, if you have cash, you can buy.
yes.
If you don't have cash, you just crash with the market. So when the market crashes, I have to start thinking to myself, oh, okay, let me go shopping. But what am I shopping for, right? So then I have to figure out what the different assets, et cetera, and that's what ends up taking a lot of time. Then the other thing is like you have to figure out when am I going to sell an asset. So I have to put different, triggers in and different. Stock sales that execute at a limit. I'll talk about that later. I put stock sales at a limit order. So you have to manage all of that, so which becomes it can become time consuming. So.
You're investing in us as we invested in
Right. I'm investing. I told him I'm gonna start charging them all the money I make them. I'm gonna start charging you. All right, so my recommendation is to invest in mutual funds, to invest in REITs through mutual funds. The one that I invest in is FRESX, and I told you I'll pull that out. And what we'll actually do is I'll show you how to read a mutual fund and show you how to read a stock. A mutual fund it's so easy. It's easier than reading the stock. So that's why I'm always going to recommend for people to go through mutual funds and index funds. Okay, let's talk a little bit about stocks. So stock is defined as a share of ownership in the company. If you own a stock, you actually own a portion of that company, all right? So remember when I said that in the beginning, bonds are the only asset classes where you are a lender. In every other one, you are an owner, even with a stock, right? You own a portion of, you're a shareholder, right? So if you let's look at stock fundamentals. So they're publicly traded companies, meaning that if you have a private company like Chick-fil-A, they're not traded on any stock exchange. But there are many publicly traded companies, right? And the two major stock exchanges here in the United States are the NYSE, so the New York Stock Exchange, and also the NASDAQ, all right? So there are also two types of stocks. They're preferred stocks and common stocks. We're not going to talk about preferred stocks because what we have access to is common stocks, okay? So common stocks, and then the other thing is that when you look at a stock, you can tend to classify them. There are three main categories that I classify stocks. There are growth stocks, there are value stocks, and then there are dividend stocks, okay? And we'll talk a little bit about what those three classifications mean. I put this up here because I wanted to show you guys this. If a company goes belly up, because remember, with a stock, you are a part owner, all right? If they go belly up, the order of payout is going to be the creditors, the bondholders, because remember, you are a lender, so they're trying to pay you out first. The preferred share of stocks, and then if anything is less left, then the common stocks, okay? So that's why it is on the spectrum, right? Bonds, a lot of people will be like, okay, bonds are better than stocks, blah, 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 blah. Bonds wouldn't get as much appreciation, but there is a place for bond assets and there is a place for stock assets, okay? All right, so let's start looking at market definitions. You guys have your phones. If you didn't get a chance, please download Yahoo Finance. All right, so let us look at a couple of stocks. Let me get my own phone. If you guys go into Yahoo Finance, you're going to be able to pull up some. Let me open it up. So your Yahoo Finance should look something very red because the market crashed on Friday, right? If you go into the search box, just search for BRK-A. Man, they were up on Friday. Dang. Yahoo Finance. I can also, let me see if I can pull it up. Yeah. Is anybody there?
Sorry, I'm a bit lost. Where are we?
If you go into the search box in Yahoo Finance,
Okay, sorry.
And then type in what?
BRK-A. So this is Yahoo Finance. CBRK. Yes. What is it trading at? Yes.
This is the preferred stock?
Huh? Yes.
Preferred stock?
Yeah. No, not preferred. It's a common stock.
Oh, that's
They never, yeah, they're class A. They never split. So Berkshire Hathaway is trading at $343,449. That means that if, yes.
I don't know why I keep tapping that.
No.
But it's not.
Oh, you're in the,
Where am I?
wait, done. What does yours look like this? See, it's that iPhone.
Okay.
It's trying to,
Okay, don't let me hold
no,
it.
it's in your list. Go back. This is, you're looking at, see? So,
Yeah, let me not hold you up. Let me not hold
hold
you
on.
up.
Okay.
Let me not hold you
I don't have your, I'm telling you, it's the Apple. So here, you see that it's trading at $343,449. That means that if you want to buy one share, you need to have $343,449 just for one share, okay? So the reason why I had you do this is mostly not to look at the price, because a lot of people think that the value of a company is based on the price of the stock, and that's not true. The value of the company is based on the market capitalization. And the market capitalization is calculated by taking the number of outstanding shares, you multiply that by the price, and that's the market cap. All right? So with Berkshire Hathaway, they have a market cap right here. Can you see it? It's small. They have a market cap of $559 billion. Okay? So now let's go to and let's look at MSFT, that's Microsoft. Microsoft is only trading at $178.59. More affordable. Better, because I don't know if y'all have $343,000 laying around just to buy one share of a stock, but I don't. Not yet anyway. But so Microsoft is trading at $178 for one share. But if you look at their market cap, what's their market cap? Anyone? No.
1.358 trillion.
Yes, they're over $1 trillion. So they're a $1.35 trillion company. So they have a larger market cap. They're worth more than Berkshire Hathaway, but Berkshire Hathaway has a larger price. Okay? So the value of a company is not based on the price. The price, you can have people that have, what do you call it? A lot of, that are very, very expensive. When you say it's an expensive, like a cost is expensive, it's just an expensive stock. If you want to buy one share, you'd have to know if you have that much money and, you know, to be able to purchase the share. All right, so we're not going to look too much into this yet, but what I wanted to do is just exit out and show you guys quickly the difference in market cap. That market cap doesn't have anything to do with stock price. All right, except for the calculation. All right, you guys make sense? All right, so there are market cap definitions, and the reason I want you guys to get this is because this is also going to be important in your portfolio strategy. So a small cap company is defined as one that has a 300 million to 2 billion market cap. A mid cap company is 2 billion to 10 billion. Large cap is 10 billion to 200 billion, and mega cap is anything that's over $200 billion. Guys follow that? All right, good. Now, let's look at PE ratio. A PE is just your price to earnings ratio. And the way that PE is calculated is that you take the price of the stock, you divide it by what is known as the EPS, or the earnings per share, okay? And based on that, you get the PE. And the PE is a way to value a company based on its price. The one I didn't have you guys look at was our Stock Pros, PRO. If you look at a company and you see the PE and it says NA, meaning not applicable, it means that they're not profitable. The fastest way to be able to tell if a company is profitable or not is to look at their EPS rating, okay? Or their EPS number. So, and the earnings per share means that for every share of stock, the company has earned $2 or $10 or $20. So for every single share, the company's earning that amount of money. If the company's not earning any money, it means that they're not profitable. Huh? Yeah, we're negative, meaning that for every share, we're losing money. We're losing however much it says on there, $1 or something like that, right?
So the question is,
Minus 1.72.
Yeah.
so the question then is this: for companies like, like you guys,
Uh-huh.
how do you guys function knowing that you're in the red?
So a lot of, especially when it comes to tech companies or companies that just IPO, the majority of them are not profitable. So when they're not profitable, they have a roadmap, hopefully, to profitability. If a company does not have a roadmap to profitability and they're just burning cash, I don't recommend you invest in that company, because think about it, right? It not only for them to have you're buying the share of a company that's losing money. The best example was Uber. So what people, like I said, when you IPO, you're actually raising cash, right? So because you're raising cash, if I'm raising cash, it means I need cash, right? So I need money to be able to do something, whether it's to fund growth, to accelerate growth, etc. So Uber IPO'd at $45, right? Uber at that time, I think it was a year ago, did not have a roadmap to profitability. Not only that, they were losing like $4 or $5 for every share, right? So their stock eventually got hammered. I don't recommend that unless you vehemently believe in that company and believe in their long-term trajectory. And I'm going to preface this by saying, and they have cash. Okay? Because it's possible for you to be losing money, but you're still cash flow positive. When being cash flow positive just means you have money in the bank. And when you have money in the bank, what that allows you to do is you ride out rough recessions. So the biggest, oh, look at that catch. So for me, if I'm going to invest in a company that is negative on profitability, I need to know that they got enough cash in the bank to be able to ride out recessions. If they don't have enough cash in the bank, they're going to go belly under. Oh, negative. Where are you at? Show me. Oh, oil is.
Yeah, because sometimes IPO is like selling dreams,
Yes.
Right? And if it depends on how selling your dream starts.
Yes.
And people
Believe it, yeah.
that dream.
Yeah.
You're right, they could be negative when they're selling it.
Yeah. But if you
It's
so
possible that over a period of time they can be
profitable, that's correct.
So,
So I agree with that. And if you look at Uber and Lyft, because both of them IPO'd, right? They literally have changed the way that our world works. I can't remember the last time I went on a business trip and rented a car. I don't. I just get out of where I call a Lyft, call an Uber, and that's how I get around. I don't rent cars anymore. So they've changed the model, the transportation model for our world. So they do have a good business proposition. The challenge with them was they had no path to profitability. But now they've started to define their path to profitability, and that's why their stock is going up if you checked on Uber.
So when you're looking for a roadmap to profitability and wanting to know about a company's cash in the bank, where can you find this information?
That's a great question. So you can listen on an earnings call. You can go scout it. All of them have because whenever a company is public, a lot of this information is in their balance sheets too. So you can for the cash, you can find that in the balance sheets. For roadmap to profitability, you'd have to listen to some of the earnings calls.
Are there minutes of those earning calls? Like you don't have to be on the actual.
Yeah, you don't have to be. They're recorded. Yeah, they're public. Yeah, they're all recorded.
I have a question. So,
Yeah.
why is it that some companies, even though they don't have a clear profitability path, they're still valued really high?
That's a great question, because we are in an environment where the market is crazy, and people, there's some things they're all hype right now, but people believe that they're going to eventually break out. So,
Because the one that's coming to mind was Snapchat when it first came out. Like,
Yeah.
there's no clear profitability. They started incorporating ads
and stuff,
revenue
yeah.
into their platform. But when I'm thinking of Uber and others, like WeWork and all that, like there's
WeWork is a
clear
disaster.
profitability path.
Yeah.
So it's like,
Yeah.
it's valued so high.
Yeah. So and that's the problem, right? And to me, that's a problem with Tesla. Why I will not touch Tesla with a 10-foot pole. Tesla's not profitable, yet they have a valuation that.
You say that.
I will not touch Tesla with a 10-foot pole right now. They're not profitable, they have a valuation that's higher than every car manufacturer in the world, with the exception of Toyota.
And I heard like they fulfill half their orders through Forward, so it's not like it's all done through Tesla. It's like
I didn't even know that part.
But
Yeah.
the thing is, if you look at the overall, you talked about trajectory. Also, there's the trajectory of the economy in the future. There are a lot of people that they're reading the whole legislative frameworks that's going on in many different countries.
Yeah.
And they're seeing that oil and gas and hydrocarbon generally
Yeah.
are getting a thumbs down. And the future
It's
has
EV,
to be in
yep.
these electric cars.
Yep.
And so even though it's not making profit, it's got one of the most difficult problems, I
Yeah.
would say. There's very little, the number of recharging stations are very few.
Yeah.
You're limited, because I think the range is
It's
240,
yeah,
300
something like that.
miles. So but because they're thinking in terms of
Long term, yeah.
the long term, you know, but like you said earlier on, you know, I mean, how long is long term?
Yeah.
So
So here's part of,
Sorry, just to second what you just said, I think in UK or somewhere in Europe, they said by 2020, 2030.
yeah, David is telling me that.
Yeah, all gas.
Got you, yeah,
So if you look at that market, alone,
Yeah.
they're driving the rest of the world.
yes.
So
But see, so here's the thing, right? If you ask me why won't I buy Tesla? It's not that I don't believe in the viability of the EV market, because I do believe that the EV market is going to be big, right? The reason why I'm not buying Tesla is because, to me, it's the equivalent of going to Mercedes-Benz and paying $250,000 for a C-Class. Their valuation is high. And it's very high for a company that's not profitable yet. So that is why I'm not buying. So if you and they don't. If you look at their there is no PE. They have no valuation, and
No P, but the beta rating is okay though.
Say that again?
The beta rating,
is what?
0.56.
Oh, that's weird. I don't know how it's only because their beta is very high to me because of the volatility. My update, I don't know. But we'll talk a little bit more about that. But that's part of the reason why Tesla is a no-go for me. Not because I don't believe in the viability of the market. And the other thing is that you see a lot of other vendors now coming into the market. I don't know if you guys saw during the Super Bowl, there was this great commercial with Porsche, who's now making EV cars, right? So you have people who have a manufacturing line who are able to scale probably faster, right? And they're profitable.
And
So
Ford is also coming into the electric car game, even when they're the ones doing half of Tesla's manufacturing.
yeah, and they're probably stealing stuff. I know you're going to hear some lawsuits later, right? But that's part of the reason why Tesla is tough for me. It's expensive stock. And when I say expensive, so the other thing is that when you look at a PE ratio, the average PE has been between 20 and 25, just 20 and 25. Remember, if a company is not profitable, you're not going to see anything. It's going to say NA. If the company is profitable, let's say like Microsoft, I believe Microsoft, I don't know if somebody can help me check on that. They've got a high PE. And that's because with tech companies, growing tech companies, the market has allowed for larger valuations. But if you look at some value companies, right? 31. Oh, they've actually gone down. Last year it was in the 50s. If you look at Netflix is over 100 with regards to the PE. If you go back and you look at somebody like Exxon is less than 20. So the PE ratio can help you to understand how expensive a stock is relative to how much they're actually making. 92, okay, yeah. All right, so let's talk a little bit about some common stock terms. So portfolio. I think everybody understands a portfolio. When I say what's in your portfolio, it means that everything, right? Your asset allocation is basically going to tell you what types of assets do you have in there. Do you stocks, bonds? Are you invested in REITs, commodities? A ticker. So remember when I gave you MSFT, that's the ticker. That's the symbol which you're looking for a company. The beta tells you how volatile a stock is. The average beta or a good beta is anything that's less than 1. Anything that's over 1, it means that the stock has a lot more volatility, which is why I was surprised. Yeah, Tesla, I was like, I don't believe that. We talked about EPS. So EPS stands for earnings per share. So that is for every single share of stock, here is how much the company is making or losing. If a company has a negative EPS, they're not making any money. A dividend, yes?
How is the EPS different than the P&E ratio?
The P&E ratio is used to calculate the EPS. So for the P&E ratio, you take the price of the stock, you divide it by the EPS, and that's what the ratio is. And the reason why it will say NA is because there are no imaginary numbers. So if it's negative on the bottom, right, then it's not applicable. Dividend. So when a company is making money, when a company is profitable, they can take some of the profits and they give it back to the shareholders in terms of dividends. So you'll see dividend payments. So one of the largest ones that I actually saw recently is Shell. Shell has a dividend payment of like 8%. So the stocker, I think the ticker is like RDS-A or something like that. But they've got that's one of the highest that I've actually seen. So a dividend payment can be good because what that can help you to do is to determine your total